Hey, thank you all for joining. I appreciate you taking the time on a weekday night. I'm John Sciuto, financial advisor, XML Financial Group. Um, Michael, Janelle, John, thank you for being here. Um, we've got a lot of people registered, but I imagine with traffic and commitments and a few other things, we'll have people drop or joining late. But I want to be respectful of your guys' time, so I'll get started in just a minute or two. But before I get into everything I'm going to talk about, is there anything particular that you're all interested in, or any questions you'd have for me before we get started? Well, if that's the case, feel free to pop a question in the chat at any point. But I'm going to go ahead and share my screen and get started with our presentation, if that's all right. So, all right. Feel okay. Can everybody see that? We've got our presentation up. Give me one second. And so Hannah and I, thank you, Michael, for the thumbs up. I appreciate that. Joseph, welcome. Um, so we've thought long and hard about this presentation, and we really want this to be accessible to everybody in various points of thinking about retirement. You don't have to be retired. You don't have to be retiring in the next 30 days. What I want you to do is, if you're thinking about retirement, this is a helpful way to plan. If you're right there, if you're right about to or just retired, this is a perfect time to evaluate if you're on the right track. And then at the back end, if you've been retired for a little while, this is a good chance to check in. So that's the lens through which we're looking at all this. Um, so here are our disclosures. Welcome to peruse them at your leisure. Um, Happy to send them to all of you. Before we get into everything, I'm going to do a brief introduction of the firm and of myself. I think it's important you know who we are, who I am, why I'm talking to you. So we are XML Financial Group. We have offices in Alexandria, Virginia, Fairfax, Bethesda, outside of Philadelphia, and Colorado as well. I myself live in Alexandria. I'm at our Alexandria office, and I'll go to the Fairfax, Bethesda office as clients need. Um, we and I got compliance approval to say this, but we have over 4 billion in assets that we manage now. We're very proud of that. I think that makes us a strong firm and shows the commitment of our clients and what we do for them. And we are a big team. We have over 50 people at XML between advisors, planners, traders, analysts, support staff, admin, and that makes for a very robust and helpful experience for our clients. It's our team is what keeps our clients happy. That's back when I had an amazing beard that didn't make it through this season. But just a little bit about myself. So I'm from upstate New York originally, went to University of Richmond to get my undergrad, went to GW here to get my master's, and then I started as a financial advisor at Wells Fargo Advisors on Duke Street in Alexandria. I I wanted a more family type atmosphere. I wanted a place to grow, and I looked around at different firms where that would be a good fit, and XML was it. Rob Cantor, Brett Bernstein, who started XML, the co-founders, have an amazing culture here, the ability for us to really cater to our clients, a ton of tools, and just a helpful atmosphere for us that makes our clients happier and better. So that's about a little bit about the firm and me, and I love being here, and our clients love being here. This is my sweet, beautiful family. I think also it's important to know a little bit about, who you might work with and why I'm talking to you personally. My beautiful wife, Riva, gave her curly hair to both of our sweet boys, Johnny, who's 5, and Robbie, who is 1, but he looks like he's 2 because he is a very big boy, very heavy baby. So that's our sweet family. We also have an amazing dog, but I saved him for the end to keep everybody interested. Okay, so enough of the fun. Let's get it down to business. I often anticipate that people ask me about the market. John, where's the market going? I wish I knew. I can make a few educated guesses, But this is a look at last year. This is the three major indices, the Dow, the S&P 500, and the NASDAQ. And you can see they were up almost 14, 17, and almost 22%. You might, without even looking at the bottom of the chart, know that this was the big tariff drop, and then kind of just everybody forgot about it, and then the Fed and kind of signaled that they were going to cut rates, and then the market kind of slowly built steam with some volatility towards the end, and then came back. So that's where we were. We're 8 days into the new year. I've already broken half my resolutions, unfortunately, but the where we're going is, as always, uncertain, but some of the decisions we're thinking about, I'm on both of our firm's investment committees. Some of the things that we're talking about are interest rates. That was the major headline story for the second half of last year. It is still important this year. Are rates going lower? The Fed has signaled that they're going to hold at their current rate, but is there going to be a change in Fed leadership? Does that mean that they're going to cut rates more? And what effect does that have on the market? Other than that, geopolitical events we've seen in the news between Venezuela and Greenland. What effect does that have on the market now? What effect will that have possibly in the future? We don't know, but these are things we're keeping an eye on, and we're modifying our clients' portfolios where we think is the right direction, both now and going forward. There's, one story that's perennially important is how's consumer sentiment and how are corporate earnings. Consumer sentiment has remained at slightly elevated, slightly positive levels. You know, there's conflicting data there. Car repossessions are the highest they've ever been since 2008, but people are willing to spend a little bit more, in their daily lives. Corporate earnings, seem to be strong. There's a lot of corporate spending, and with lower rates, they're able to get more financing at lower rates, so that's helpful as well. But in various industries with, changes both economically and regulatory wise, there's some benefits for some companies and some challenges. So it just depends on the industry. I say all that in that we're cautiously optimistic. If there are big changes, we let our clients know and we change their portfolios on that. But this is something that, our investment committees, we talk about quite often, and think about and enact changes for our clients' portfolios. So again, that's a long way of saying I don't really know, but we're constantly thinking about and analyzing. I already went through all this. Market volatility, tariffs have fallen off in importance, but are always kind of a risk. Central bank actions are just as important. Inflation is doubly important if the central banks, both U.S. and worldwide, are going to cut more. And then the other parts I talked about, consumer sentiment and spending. Okay. So let me talk about the 5 questions that we built that we think really help you check in on your retirement. I won't go through them now here. Let's just go through them one by one. The first is, what are the biggest threats to your retirement? I think that changes over time. So in this chart here, you can see early on, this is before retirement, your retirement hits, and then your life continues post-retirement. The importance of market volatility, I think, is higher early on. And I got a little light math on the next slide. Spending behavior, always important, but really important early on. Then inflation, healthcare, and longevity. And let's go through these each one by one. So this is thank you, Hannah, for the poll here. Please jump in on this, and you can answer now, or I don't want to give away the answer. You can answer in a bit. Let me go through this scenario with you. We have 2 clients, okay? And they are, gave that away, forgive me. They are the same, but they are different. So we have Mary and we have Jim. They both retire with $1 million on the day they retire, and they need to take out $50,000 every single year. They experience an average return of 6%. But the difference is they have a different sequence of returns, as it were. So early on, Mary has great positive returns. She is up 16%, then up 31, up 9%, down 1.5%, and in year five, down 25%. So starts strong, then tapers off. Jim, on the other hand, is has the opposite returns. He's down 25%, down 1.5%, up 9, 31, 16 for an average of 6% returns. So they have the same amount of money dollar wise at the end of the 5 years, right? Well, of course not. It's a trick question. You'll see that the $1 million that they both start with for Mary, just to get to the ending first, she has just slightly over a million. You guys are good. I love that. This is some smart thinkers. Um, so Mary early on, experiences that positive return and then has the big drop. She still is taking out 50K a year, and she still has over $1 million at the end of the 5 years. Jim, that hit early on to your portfolio, it crushes the principal that we're looking to both grow and withdraw from over those 5 years. So he has less than 900 grand at the end of those 5 years. And that is a lifestyle change. That is significant. That's the difference between you have to make trade-offs and choices. Whereas Mary, basically, she hasn't touched her principal. So, we're not able to predict the market, and we're not able to, determine exactly what's going to happen, or what your returns will be. But I generally find that getting clients more conservative in an appropriate way for their risk tolerance and lifestyle, we can try to mitigate this. We can't prevent it, we can't predict it, but we can try to mitigate some of the negative effects. And that's what we look to do. Okay, what day of the week do you spend the most money? This is, you can see it, but indulge me with an answer. Um, it is it's of course the weekend, and this is less of a hard data question and a more of a mindset shift I'd like you to have. Um, every day in retirement is the weekend. You have no working income coming in. Maybe you've got a pension, maybe you've got an annuity, maybe you've got Social Security, maybe you've got your portfolio of stocks and bonds that throw off variable interest. Yep, you guys nailed this. The point is, I want you to think like every day is a weekend, and that is scary. Making that leap. That's one of the biggest things I do is counsel my clients during these, um, you know, tough, difficult but necessary and exciting transitions. And going from working to not working seems great until you have to start filling out the paperwork, and then you realize that paycheck's not going to be coming in. And what we do is often we take a client's accounts and then we just send them twice a month, once a quarter, whatever they want, basically a paycheck replacement. And it's their money. That's what it's there for. And that helps kind of alleviate some of the stress. All right, so healthcare may be your biggest cost in retirement. I hope it's zero for everybody, but unfortunately, it generally statistically is the highest cost for anyone in retirement. The estimate is $285,000. That's net of taxes and does not include long-term care for a couple in retirement. So that could hypothetically be 15% of your annual expenses. Now, most likely it's not early on 15%, but I'd certainly say in your later years, if you're budgeting or have me or someone like me do a plan for you, take 15% off the top, especially in the later years, just to be conservative, to make sure you have that essential healthcare need covered. And this is a quick slide. This just shows the power of inflation. If prices rise 4% annually, a dollar today is worth 82 cents in 5 years, 66 cents in 10 years, and it is worth less than 2 quarters in 20 years. Inflation will change. Inflation is higher than average now. It has been for a while. It's just kind of been the nature of the market and interest rates. But this is a responsible number to project going forward. This really only affects people if you have a ton of cash or CDs or treasury bonds that may not be able to keep up. You may live longer than you think. With all those expensive healthcare costs, a 65-year-old male in good health has a 50% chance of living to 87. For a female, 50% chance living to 90, and a couple 50% chance of living to 94. So I do all my financial plans, which I'm very passionate about and do for all my clients, to 95. That is the best way to try to all weather your plan. I can increase your spending. I can do all these things to kind of try to beef up how conservative your plan is, to beat it up so that you can go forward with more peace of mind. But extending life out to 95 generally is the best way. So one of the biggest threats to your retirement, I don't think I buried the lead, not having a written plan. And again, I do this for my clients, and it is a crucial exercise that literally makes a difference in their daily lives. I've had multiple clients who retire earlier than they thought because we do their plan. We stress test their assets, their goals, their spending, their everything, and they decide, hey, I'm going to retire 2 years earlier. And I mean, that's just for having me do some homework. You get 2 years of life not working, doing whatever you want. So that's my why. That's why I do this job, is for moments like that, for having people retire. And the other one is having kids go to college. We've been saving for years, and having that kid go to college is really exciting. So those are my two most exciting parts of the job. Um, so okay. Let's move on to the next question. When should I begin taking Social Security? I'm sure you're all experts, but indulge me if I just do a little basic explanation, then we get into it a little bit more. So your, oh, this is great. So the full retirement age is considered between age 66 and 67. Depends on what month and year you're born. That's right here. Not theoretically, but statistically, mathematically, there is a 6.7% reduction in benefits every year between your full retirement age and 62. Conversely, you can look at that as a 6.7% increase in benefits from age 62 to your full retirement age. After that, there's an 8% increase in benefits. So at first you'd think, okay, John, great. I should just wait until 70. I should try to capture as much of the baked in increase as possible. The short answer is it depends. Okay, so what percentage of people claim Social Security benefits early? So everybody thought between 50 and 75%. All right, hold on to that thought. I want to do a little bit of math, because percentages that's really how I operate. But let's work with some hypothetical numbers. So let's say your full retirement age is 66 and you get 2,000 a month, or 24K a year for your Social Security. If you claimed as early as possible, that drops down to 1,500 a month. That's 18,000 a year. If you wait until 70, that's over 31,000 a year. That's a 76% increase. So, on paper it says, yeah, I should get that benefit. I should wait until age 70. I have very few clients who wait until age 70. I just do the math and I present it to you, and we make a decision together with as much information as possible. A lot of people have the feeling that, hey, Social Security may not be around in next year, let alone 10 years. Or they think, you know what, John, I don't need the Social Security, but instead of waiting, I'm just going to claim it early and I'm going to invest it. Or some people just say, I want the comfort and security of knowing that I have an income source from a guaranteed source that is in retirement. So it's a comfort level. And I think all of those answers can be correct. We just need to do the plan and do the homework and make sure that it's good for you not only now, but 10, 15, 20 years from now. Okay. You guys, you had great answers. You're exactly right. So 62% of men and 68% of women claim their benefits early. That is before their full retirement age. Only 5.2% of men and 4.5% of women claim late. That is after their full retirement age. So 95-ish% of people claim at their full retirement age or earlier, with the overwhelming majority being claiming early. So I think it really is that comfort level thing of wanting to have that income source after you retire. And I don't think there's anything wrong with that, as long as the rest of your plan and finances make sense. All right, so when should you begin taking Social Security? Make a plan and have it make sense, and make sure it is stress tested and you know what you're getting into, because once you make your Social Security decision, that's it. You can't walk it back. Also, I have a lot of federal government current and former military employees. I have some CSRS, old school, pre-FERS pension employee or clients, and there are some windfall exemptions and some other things to take into consideration when considering this, so that you should be doubly sure, measure twice and cut once, when working with that. Okay, how much can I spend in retirement? I want the answer to be a lot, but it's different for everybody. So basically, all this slide says is make a budget, which is, nobody wants to hear. It's not the most fun exercise, but hey, it's the New Year's. People have a lot of financial resolutions. This is, a great place to start. I have a great, spreadsheet and tool that I can offer people. But you want to break down your retirement expenses, your essential, food, mortgage, healthcare, your discretionary, everything else. Very common sense. Everybody knows this. Write it down, or if you don't want to, talk to me. We write it down, put it together, match your income to your expenses. And the other thing I think is important for people to know is that I, I consider rental income, portfolio income, and part-time income that is not necessarily guaranteed. I don't know what your portfolio is going to do. I mean, treasury bonds are about as close as you can get. If you have an insurance contract, an annuity, a government pension, that is all fine. And also part-time employment, that by nature it's part-time. You may not pursue it. I need to factor that in. And then rental income. There may be renters 1 month and maybe not. So I really stress test that. This is the whole crux of the issue. What is the income gap between your income and your expenses? And the shortfall, that is a tough conversation. If I do all the math for you, first off, I am not going to be shy. Not that long ago, a couple months ago, had a client and her spending increased dramatically. And I told her, I said, you have 9 years and change on this spending before you run out of money. I don't want you to be surprised. And this is my advice to you is to make some changes. And I'd rather tell someone that up front and be very forward and mathematical and show them exactly in black and white, why this is the case. Because you don't want to get 9 years into retirement and realize you're out of money. So if there is that shortfall, you either have to work longer, spend less, save more, leave less to your heirs, increase your risk tolerance, which I basically won't do. That's if somebody comes to me and say, "Hey, I need to double my money in 3 years to retire," then we're not a good fit. That's not a realistic goal. Or withdrawal from principal. Excuse me. The surplus conversation is fantastic. I love doing that. That's like I told you, that's the biggest joy of my job is doing all the math and really stress testing it and saying, hey, I think you can retire earlier. You can spend more in retirement. You can spend more while you're working, leave more to your heirs. My favorite, you can decrease your risk tolerance. If I can put you in a safer, less volatile allocation, and that still gets you to your goals, that's win-win. And then also you can just save more, really contribute to your investment portfolio. So how much can I spend in retirement? We determine your priorities, we match your income to your expenses, and then we just, again, do a plan. We really make sure that we have a robust, strong plan, going all the way till you're 95, and then whatever your estate is. So how should you invest in retirement? A lot of people think, hey, John, the reason my portfolio went up is because I bought Nvidia, 2 years ago. And that very well may be the case. But unless that one stock security selection is the overwhelming part of your portfolio, that's not the full real driver of why your account goes up or down. It's strategical asset allocation, which is a fancy way of saying diversification. Are you diversified? Different parts of the markets do better and worse, at the same time. Small caps are up, but large cap values down. So we try to be very thoughtful with our allocation of clients. Everybody's custom. We don't use cookie cutter models. I see what your goals are and I build something for you. I do have a universe of things that I like to invest in. There's only so many things that are high quality enough, but I piece them together in a thoughtful way for you. And then again, with our team, our planners, traders, our investment team, we all talk and think about what are good assets for our clients? What's a good asset for someone who is, retiring now, retiring in 10 years, has been retired for 10 years. And then we diversify you in a thoughtful way. The other thing is tactical asset allocation. That's day trading. I do not do that. You're welcome to do that on your own. That is a wild ride that I don't want to put myself or any of my clients through. All right, so this is a great snapshot, but an unfair snapshot, but one that illustrates a good point. So this is a 10-year period from 2004 to 2014, and you can guess without even looking where this is. This is 2008. So in this decade, you have this blue line, that's a 100% stock portfolio, and this kind of orange brownie line is half stocks, half bonds. Over this snapshot, just this 10 years, they both kind of performed the same. They performed within 50 basis points, half a point of each other. And this, the half stock, half bond portfolio was a much smoother ride. However, if you zoom out and look over 20, 30 years, or, take it from 2004 to today, the all stock portfolio is going to win. Over the long term, that is just historically the case. It all depends when you get on and get off the ride of the stock market, when you buy and when you sell. But this is mainly used to illustrate, hey, what is important to you? Is it more important to you to sleep at night, that your portfolio is less volatile, even if it means leaving some gains on the table? Or do you have a higher risk tolerance and you're willing to maybe have some sleepless nights where your portfolio is down, but overall you can wait a little bit longer. You don't need to take the money out right away. You can wait for the recovery. So this is just one thing we talk to clients about to kind of gauge their risk tolerance and just to get you thinking about it. This is a kind of a different way to look at the same thing. So this is from 2007 to 2015, and this is a hypothetical journey of a $100,000 portfolio. So $100,000 starts here in '07. At the trough of the crisis, early '09, it is almost cut in half. Three paths here. If you did nothing and you just said, John, I'm out of the market, I'm taking my money, I'm putting it in a coffee can and I'm burying it in the backyard, then that money stays there. It is less than $55,000. It's locked in. You've got peace of mind, but it's locked in at a low rate, at a low exit point in the market. If you were to say, all right, John, I'm just going to get out of the market for a year, then I'm going to get back in. Totally reasonable. But if you miss the few highest days each year of a market, it devastates over the long term a portfolio. Those high days make a very big difference. So let's say you're out for a year, that 100,000 turns into about 114K by 2015. You've made your money back. If you didn't look at your accounts and just let it ride, the 100,000 turns into 175,000. So that's these paths are right for different people. My job is to, when the big drop hits, the most recent one was 2022 and really earlier in 2025. But 2022 was a bigger and a longer drop when interest rates were hiked. I was doing a lot of hand holding, and it felt very good to hear clients were appreciative, a year or 2 years later, when they said, John, I'm so glad I didn't go to cash. I'm so glad we had a plan and we stuck with the plan, because that, more than even asset allocation, the best thing I can do for you is keep you invested, during a downturn, and keep you appropriately invested beforehand for your risk tolerance. So that's I think really important for people. The last question we would have you ask yourself is, are you on track? And if you're here listening to me now, I imagine that's something that you're thinking about. We want everybody to win, like Ovi and our local favorite, the Caps. The way I achieve this, and I've talked this to death, but is through planning. And we use eMoney. So one of the best things about being where I am, at XML Financial Group, is that we are not locked into anything. Again, when I was at Wells Fargo Advisors, we had to use their planning software. We had to use their custodian. We had to use, their approved stuff. Here at XML, we're independent. If we think one tool is better than another, we use that. We used a variety of different planning tools before coming across eMoney. I use it personally. I use it for my family. I use it for all my clients. It is it is so robust. I can produce a 300 page plan for everybody. Now that gets to the point of diminishing returns where it's not as helpful. But if you are considering retiring, buying a house, saving for college, leaving an inheritance, any of that, I can plan out where your income's coming in, what type of income, what do your RMDs look like? If you have a very big 401k, TSP, traditional IRA, 403b, when you turn 72 or 73 or 75, depending on your age, you're going to have a big tax bill. And that's something that I can plan for now. Um, you can get really granular, not to the point where you lose yourself in it, but to the point where you can get comfortable making a big decision because it is, the vagaries of the market are unknowable, and we can plan for them up and down. But I find this gives clients a lot of comfort to make big, tough decisions. Um, one of people's favorite charts is, hey, what's the earliest I can retire? I'm over this job. The commute's too long. My coworkers are, I'm sick of them. I want to retire today. Well, I press that button and I say, it's going to be a year and a half, and you're going to kind of skate in when you're 95. You won't have much of an estate, but here's your earliest retirement. Another part of the plan people like looking at is, hey, what's the most I can spend during retirement? I'll work a little longer, but I want to spend more. I want to visit the kids. I want to travel. We want to, buy that house on the beach. And I say, okay, let's plan for it. So these are just two small examples, but I think it is the working with me and the building the plan and then going over it together that I see clients kind of, realize, okay, I can retire. I've been hesitant, but I can. And then when we talk 1, 2, 3 years later, they say, John, I can't believe I ever worried about it. So that's really important. Um, so if you're on track, again, ask those 5 questions that I outlined. How much income do you need a year? Nobody has given me a satisfactory answer because it's a tough question, but I always ask, what do you spend a year and what do you need a year? And what do you think you need a year in retirement? It's a very hard question, but then I kind of back into it and, usually add a little bit extra to make it more conservative. The next question it would lead into, is your retirement sustainable for your life? Yeah, maybe your 5 year cash flow looks good, but I have you living till 95. Some clients tell me they have longevity in the family. We bump it out to 100, because I'd rather see, how long will your money actually realistically last? And then the last one, are your investments allocated properly for a downturn? That's just proper asset allocation for you. Everybody is different. They have their own needs when it comes to risk. They have their own goals in their head for return, which I'll never guarantee and, is, unknowable like the market. But focusing on, are you too risky right now? Are you concerned? Are there signals that there is a downturn around the corner? Do you want to cash out something while the market's high? These are all questions that I explore with my clients until we come to a good allocation for them. So again, these were the questions. We talked about what are the biggest threats to your retirement? When should I start Social Security? How much can I spend in retirement? How should I invest in retirement? And am I on track? Um, as a firm, just a little bit more. Obviously, I stay in my lane. I care a lot about financial planning, investment allocation, and working with my clients from that perspective. But we also have estate planning. Oh yes, please feel free to contact me. Um, so we have estate planning. We can't draft documents, but we do have a lawyer that can help out. We also can refer you to people I've used personally. The same thing like with an accountant. Uh, I think one of the benefits of working with a financial advisor is, I have a stable of vetted financial adjacent professionals that I use personally or I heartily approve of. Accountants, really want 2 accountants, 2 estate attorneys, Insurance, annuities, life insurance, um, y- y- home insurance, car insurance, pet insurance. I mean, I try to have a guy for everything, payroll, even things that, that go as far down as, painting your house, or, big ticket items that I think are important. I like to, I think having a good Rolodex is helpful for clients. But we offer all of this in one way or another. Philanthropy is becoming a big one. We can do donor advised funds, things like that. But Phil, I can always talk more about this individually if people have interest in that. Um, so again, we feel like we help our clients in a variety of different ways. One thing I want to offer everybody here, since you sat through all of this and you listened to it, and I really appreciate it, is I would create a version of this financial plan for you complimentary. Um, we could have a discussion or two. I get to learn your goals. I would need to ask some nosy questions, know your assets, things like that, and then I can put together a plan for you that I think would address a lot of your concerns. It won't be a full plan. That's kind of for clients only, but it would be a version of it that I think would answer a lot of your questions. You would see how I work, and then you could decide if you wanted to work with me. I think that's only fair, that we would get to know each other a little bit, and you see how I operate before making that decision. But the plan is, offers a good amount of what the full version is, and I think would help answer a lot of questions. Again, it's no obligation. You do not have to work with me. If you currently work with an advisor, you get a second opinion. If you're doing it yourself, you can check to see if you're on track. You don't need to work with me. If we're a good fit, I would love that. But it's something I would want to offer everybody here. Um, but I would, I also offer in-person meetings at our office in Alexandria if you're close by, and elsewhere. Happy to do a Zoom or a call as well. So again, I really appreciate you all being here. I would love if you all took me up on creating a plan for you, and I would be happy to answer any questions that anybody has. Oh, and that is my dog Cal. I promised at the end. He's much bigger. He's 102 pounds now. That's when he just graduated puppy school, which unfortunately he's forgot everything. But he's a Lassie like collie. My wife's dad actually used to breed collies. I really wanted a lab. My wife Riva wanted a collie, so of course we compromised and got a collie. But he has been great with our kids. He's been a great dog. But anyway, any questions, please? Either shout them out or drop them in the chat.